Hello friends, welcome. Friends, today we are going to do a very interesting analysis, and I'm quite sure that whoever is watching this video will find this analysis very useful and thought-provoking. The question that we are going to answer today is that whether the Indian economy is going to see interest rates as low what we saw in FY 21-22 anytime soon. Now friends, you might recall, whoever is following the economy very closely, that interest rates were held very high in the initial years of this particular decade, which is starting from 2014, where you saw that the policy rates were held very high to a level of 7.5% to 8%. And then from FY 15, the rates were slowly driven down to a level which went to 4%, 4.5%. And then thereafter in FY 2023, the rates again started rising. Now friends, why this question is so important? The reason this is important is that it impacts our lives. When the interest rates are low, the borrowing becomes cheaper and people tend to spend more. The liquidity in the economy increases and it kind of results in more activity within the economy in the point of view of purchases and goods and services. When the interest rates are held high, it results in more savings. Now friends, before we get into this discussion that how it is going to impact the overall economy, how the interest rates are being driven down or higher and lower, we need to first understand some concepts. And those concepts are extremely important for driving this discussion forward. Let's understand those concepts first and then we will go forward in this discussion. Now friends, to understand the concept, you need to look at this dashboard. And let me explain to you what is this dashboard all about. Now if you look at this dashboard, you will find that this dashboard has 1, 2, 3, 4, 5, 6 rows. Every row is capturing a particular dimension of the economy. The top row is the yields of the T-bond rates of the central government. Now friends, you know that the government of India take loans from the public. In order to take loan, they issue bonds. People participate and purchase these bonds, and in the process, using these instruments, the government of India is able to fund their deficit, because whenever there is a budget, there is a huge deficit which the government of India encounters, and in order to fund those deficits, they have to borrow from the market, and they do so by issuing bonds. The yield rates of these bonds are determined by an auction process. There are different types of bonds. Bonds are of shorter duration, 1 year. Even there are bonds which are of lower duration as well. And then there are bonds of higher duration. It can go up to 15 years, 20 years, 30 years. Now you might have seen that the various bonds have got various interest rates. The lower duration bonds typically have lower interest rates compared to higher duration bonds where the interest rates are higher. Now, what is the concept here? The concept is that the lower duration bonds interest rates are driven by the RBI's policy rates. It's a very important concept to understand. And the higher duration bonds interest rates are driven by not the RBI policy rate but the perception of inflation which an individual has about the economy. Now why it is like this, that also let's understand. Now when you are purchasing a long-term bond, let's say 10 years, and let's say if you are perceiving an interest or inflation of let's say 7%, I am picking a number, you won't be purchasing or paying or participating in the auction process and purchase a bond of an yield of 6%. Why you do that? When you are perceiving an inflation of 7%, you will definitely like to purchase a bond of a higher yield, let's say 8%. Therefore, your perception, what you perceive that the inflation would be of a longer duration period, for a longer duration of time about the economy, your ability to purchase a bond will be dependent upon that kind of visibility that you have about the inflation of the economy. So, if you are perceiving an inflation of 7%, definitely you are going to purchase a bond of 8% so that you don't end up losing money. Now, let's say if you are purchasing a bond of shorter duration, let's say 1 year or 2 year, this is driven by the policy rate of RBI. Why it is so? Because what is RBI doing? RBI is setting interest rates at which the banks can borrow from them. Now, what is bank doing? Banks have got certain liquidity, so they lend money to the public. Now, when they are lending money to the public, it may happen that some days they may have excess fund and some days they may have less funds, because they would definitely not like to keep funds to themselves. They would like to lend funds, then only they will be able to make money. So, if a bank in a particular day has got less funds compared to what they actually need in order to fulfill the requirements of the public, they will borrow from each other, right? So that interest rates, that market of borrowing will be determined by the liquidity. The first thing is that how much liquidity is going to be there. Let's say if a certain bank decides to lend at a higher rate, and if money is available from RBI at a lower rate, why would a bank borrow from that particular entity? It won't, right? Suppose let's say bank A and bank B, they are lending out to each other, and bank B decides to lend at 7%. Let's assume that, right? And RBI is saying that I am going to lend to any bank, whoever wants it, at a lower percent of 4%. Definitely bank A is not going to borrow from B, because B cannot decide a rate if RBI has already set a rate for interest rates which anybody can borrow, because RBI is the bank of last resort. Normally the banks will borrow from each other, but let's say if there is a dearth of money and if there is no other resource available, the banks will borrow from RBI, and therefore the short-term interest rates are driven by the RBI's policy rates which the RBI fix. Long-term interest rates are driven by the perception of inflation. This is a very important concept to understand. Now let's see why RBI drove interest rates which were at a very higher level in the initial years to a very low level in FY 21-22, when it became at the bottom. The interest rates actually were driven down at the bottom. See, the primary reason for driving interest rates low, as I told you earlier also, is that we need to trigger more economic activity. Because if you are going to drive interest rates low, then what happens is that you are able to trigger more liquidity in the system, because people will be spending rather than saving. Because what will happen is short-term loans are going to be cheaper. Because if the banks are going to lend to each other at a lower interest rates, then their saving rates are also going to be reduced, because then they will not have to shell out enough money for serving their requirements on a daily basis. So their interest earnings are also going to be less, and therefore they will be spending less money to savings. They will be giving less interest to those people who are saving. So ultimately the loans which are being taken by corporates and public for a lower duration of time will get driven down to a very low rate. That's the whole point. So if you are going to have loans which are going to be available at a lower rate, what you are going to do? You are going to take more loans. If you are going to take more loans, you will have more liquidity. When you have more liquidity, you will basically purchase more goods and commodities, and you're going to spend more, right, in various kind of activities. Maybe you're going to basically make investments, you're going to buy capital goods, you can make investment in your factory. That will result in more goods and services. But there is a danger as well. What is the danger? Let's say if you have more liquidity in your hands and the supply chain is constrained. means goods and services are not available in the market, and to an extent that is getting driven by the increased demand, then what is going to happen? Inflation is going to increase. That is the risk of pulling the interest rates so much down so that it results in an imbalance in the economy from the point of view of goods and services. More money is chasing less goods, which results in higher inflation, right? The second problem is that if the inflation is already very high, and if you are going to pull down the interest rates to a very low level, and that is resulting in more money into the system, then what will happen? Inflation is going to increase further. Because if you are not manage the supply chain, and if you are going to if you are injecting more money in the system in form of cheaper loans, that will further drive the inflation high, because you have not managed the supply chain. More money you have injected into the system, people are going to buy more goods and services, and that is going to drive the inflation very, very high, which will in turn have an impact in the GDP growth. Why? Because more inflation, more the borrowing cost, long-term borrowing cost. The government generally fund their fiscal deficit by how? They basically take bonds, they issue bonds of longer duration in the market, whose rates are driven by the perception of inflation, not the actual inflation, the perception of inflation. So once the longer duration bonds have a perception of inflation of a higher rate, then the rates of these bonds are going to increase, and therefore the government's expenses in terms of interest payments are going to increase. So they will not be able to spend money in fruitful activities, useful activities like spending in capital, all kinds of various activities which are required to drive the growth of the economy, because economy's growth is not driven by spending in expenses like salaries, etc. It is driven by spending money in capital investment, right? So they will not have money in capital investment. So that is why, given this context, given this explanation, let's evaluate the situation whether the government has now the liberty to drive the interest rates low to an extent what we saw in FY21 and 22. This is the question that we are trying to understand. Now, before I take you through the explanation, let me explain to you what dashboard that I have. I already told you that the first row is the rates of T-bond. The bonds that the government of India is issuing for funding their expenses. That is the fiscal deficit, the bridge that they have in the budget. So they are borrowing from the market. Now, if you notice here that this is the second row is the RBI policy rate. When the RBI policy rates were held high, you will find that the dispersion in this particular curve, because this dispersion that you see, different lines that you see, are bonds of different duration. So if you see here, this is the bonds of the 1 year duration of an average yield of 8.6% in FY 2014. Now, if you go here and if you see, if I go on top, you will find that it is 9.15% for bond of 13 years, 13-year T-bond of an yield of 9.15%. So higher duration bond has got a higher yield, lower duration bond has a lower yield, but it is driven by the RBI policy rate, which I explained to you. So the dispersion in the bond yields are lower because the RBI policy rates were held high in FY 2014. Now, as the rates started going down, you see the dispersion in the bond yields have also started increasing, and it went maximum in FY21. See the dispersion here. The lowest yield bond has 3.8% interest rates, and the highest duration bond had an interest rate of yield of 6.93%, because we have held the RBI policy rates were held very low in FY21 and 22. And then after that, as the inflation started increasing in the system because of COVID and other kind of spending which RBI had to do, the social spending, RBI have started increasing rates. Now the dispersion has again started reducing. See, the the 1-year bond is yield is 7.13% and the 10-year bond the yield is 7.46%, right? And now the interest rates have been held as 5%. Now friends, in the earlier year, why RBI was able to drive the interest rates low? The reason they were able to do it because the GDP growth rates were held high. Generally, the rate, if you see in the initial stage years, if 7.41%, 8%, 8.26%, then it went to 6.8% in FY18 because of demonetization in FY16. The whole thing, there was an impact there, and there was GDP, the GDP of the country reduced, and therefore it went down. And then it became 6.45%, and now in FY20 when the COVID was hit, the GDP growth rate became 3.87%, and then finally it went to negative, minus 5.83%. So unfortunately, when we drove the interest rates down with an objective of triggering more economic activity to drive the GDP growth rate higher, because that's the whole purpose of driving the interest rate low, because we will trigger more activity. Unfortunately, that objective was not accomplished, because as we drove the interest rates down, you see, the GDP growth rate also went down. And then in FY22, the GDP growth rate became 9.05%. Why? Because of lower base effect. The base was low, therefore it appeared that the GDP growth rate is high. Now, the GDP growth rate number is 7.24%, and the projected GDP growth of FY24 is 7.32%, which is also a very risky number, because if you look at the data, you will find that there are a lot of questions, ifs and buts, whether we will be able to meet the GDP growth numbers or not. Therefore, in a situation like this, where in a delicate situation, where the GDP growth was low and now we are pulling up the GDP growth, and as the interest rates have also increased, in a situation like this, the RBI cannot take the risk of reducing inflation, interest rates to a level what we saw earlier, because if they do so, and in the process the demand becomes higher and the supply of goods and services is not able to cope up with the demand, it will result in higher inflation. Now, if you look at the inflation, here inflation, the CPI inflation, the inflation actually is 5.69%. So inflation, though it is 7.79% in FY23, then it got slowly down, though it is under control, but still it is not within the window which RBI would like to have. RBI's inflation, basically they want to maintain it between 2 to 4%. Still it is very high. So under this current situation, the RBI cannot take the risk of driving inflation interest rates low, because it may increase the overall inflation, which might impact the expected inflation of the economy, because the yield of the higher yield bonds are driven by expected inflation, not the real inflation, as I explained to you earlier. So if the expected inflation rises, then it kind of changes the behavior of the participants in the economy, and that has a spiraling effect. Let's say if I assume, my assumption is that the inflation is going to be higher in the economy, then I am going to price my goods and services higher. The employees in my company is going to demand higher wages. So it will have a spiraling effect on the overall economy. So it will basically drive the inflation further, the real inflation further, just because the expected inflation has been higher among the public, and therefore to bring confidence within the public and the people and the participant of the economy, RBI has to demonstrate that it is really serious in containing inflation. So friends, under these circumstances, given the situation that we are in, with so much amount of obligation that we have, the fiscal deficit has already increased to a significant level. Do you think at this particular point of time, RBI will take the risk of lowering inflation, interest rates? Sorry, I don't think so. It's not going to happen, right? So that is what I thought of explaining to you. Now there are certain other things which I'm going to see. Let's look at some of the other matrices which actually kind of further amplify what I'm trying to say. Look at the GDP numbers. This chart on the left hand side shows the GDP trend, right? The real GDP. And on the right hand side, basically it gives the Government of India's account. So let's look at the GDP number. GDP, you know that was steadily rising from FY14, the real GDP, and then it went down, and then again it is on the rising path. But the risk of GDP growth is because of rising imports as well as increasing exports. Because imports, if your imports are going to increase, it is going to have a negative impact on the GDP. Now, unfortunately, even though there are a lot of PLI schemes the Government of India has recently launched, it still has not been able to contain our imports. Our imports are increasing, right? So, because imports are increasing, it has got a further impact on the depreciation of rupee. The rupee depreciates and it further increases inflation. So we have to be very conscious about the fact that we cannot do anything in the economy at this particular point of time, which kind of drives the GDP growth down, because there is already a lot of challenges that we have on our ability to manage imports. And exports are also going to get impacted, because if we are not competitive, in the external market, and we have higher inflation, because if we have higher inflation, then we have a problem, and our goods and services are not going to be competitive in the external market. Now, in the global market, and now the other thing is the budget, which you will see that the new budget is going to be announced very soon. But one of the very important factor of the budget is interest expense. Now look at this chart. You'll see interest expense. The budgetary estimate of this fiscal year of interest expense is 10.8%. 10.8 lakhs. Now 10.8 lakhs out of the total budget of 45.03 lakhs is a huge number. So you see our total budget is how much? 45.03 lakhs, out of which 10.8 lakhs is interest payments, and this is at par with the capital expenditure. The capital expenditure which we have estimated in our budget is 10 lakh crores only, and our interest payment is 10.8 lakhs. So more, if you are expected inflation in the bonds, in the higher yield bonds are going to increase, this particular interest payments obligation is going to further get aggravated, because government tend to borrow for a longer duration. Most of the time the government bonds are for a longer, though we have shorter duration bond, but we have longer duration bonds also, which will further put a lot of strain in our accounts, in future accounts. So we have to be very mindful about this. So I thought of bringing this before you, and I hope that you have understood what challenges that we have to manage, and that is why all our actions, right, public as well as government, has to be responsible in nature. We cannot basically waste money in various kind of schemes which are non-productive in nature. We have to be very careful how we grant subsidies, because subsidies are important, no doubt. It kind of triggers more benefits in the long run, but we cannot be wasting money in subsidies where there is no productivity, right? So therefore, lot of things that you see that goes around in the public which are more populistic nature have to be constrained, because if we are not able to manage inflation, it can have a huge detrimental impact in our economy going forward, and that we should be conscious about. So friends, that's all for this video. I hope that you understood what I'm talking about, and let me know in the comment section what you think about it, and I'll come back to you in the next time with a new video. Thank you very much. Thanks a lot for your patient listening.